Good afternoon, doctor. My name is Bevan. I'm from Group 11. Today, we are going to present our group project 2, and our topic is assembly, rebalancing, and performance of a portfolio with different asset classes. First is our introduction, background, and objective of the study. In this research, an investor contribute a 5,000 investment capital to create a robust and various portfolio comprising 4 effective stocks from Blossom Malaysia and another 1 effective stock from an international stock market. The 5 effective market that we have choose are Allianz Malaysia Berhad for Malaysia stock market, Dayang Enterprise Holding Berhad for Malaysia stock market, Pros Malaysia Berhad for Malaysia stock market, Prismetal Aluminium Holding Berhad for Malaysia stock market, and the last DBS Group Holding from Singapore stock market. Next 1.2 assembling of store. The assembling of store refer to create a portfolio or an assortment of various store as well as security. Assembling process involves combining component parts and assembling to create a complex product. Process can be categorized as testing, fitting, and handling. In summary, stock assembly is crucial in manufacturing for creating quality product efficiently, whether done manually or with automation. It improves product flow, reduce lead time, and cut costs, thereby enhancing overall productivity. 1.3 Rebalancing of portfolio. Portfolio rebalancing is strategic method used by investors to regain their portfolio asset allocation back to their original target. This practice helps maintain an optimal balance between risk and return over time, aligns with the investor financial goals and risk tolerance. By particularly buying and selling assets based on market movement and portfolio performance, investors aim to minimize long-term return while minimizing the potential downside of market fluctuation. Overall, portfolio rebalancing as a proactive approach that ensure investments stay aligned with changing market condition and investor objective. 1.4 Portfolio performance. Understanding portfolio performance helps investors make informed decisions about asset allocation, investor strategy, and risk management to align with their financial score. By regularly monitor and adjust their portfolio based on performance analysis, investors can strive to optimize return and manage risk effective in varying market conditions. Next, we are going to 2.0 economy analysis. Based on the graph, it has shown Malaysia gross domestic product and global domestic product. It has shown that GDP of Malaysia decreased from 2019 to 2020 caused by the economic slump when COVID-19 pandemic. The GDP of Malaysia for the following year increased until 2022 and reached 8.69%. GDP global also have increasing when 2020 to 2021. Overall, the GDP of Malaysia and global is growing and business activity increasing. Next, 2.2 current exchange rate. The graph displays the current exchange rate of the Malaysia per SGD between 2019 until 2023. The exchange rate in 2019, Ringgit Malaysia 3 Ringgit 4 cent per 1 Singapore dollar increased to 2023 3 Ringgit 40 cent per 1 Singapore dollar. As the Malaysian Ringgit exchange rate has considerably increased, mean that Malaysian ringgit was in depreciating. Next, our last economy analysis is Malaysia inflation rate. Last, the graph show the inflation rate of Malaysia between 2019 to 2023 exhibit significant fluctuation reflecting the country economy responsive to both internal and external factors. Starting from a decrease in 2019 to 2020, after that rise to 2022 with 3.38%. They all for me.
My name is Gong Ketian with metric number 285140. Now I'm going to present about the industry sector. Okay, the first one is industrial products and services industry. Based on the graph chart above, we discovered that the industrial and product services industry experienced an upward trend from January to July 2024. The companies our group have chosen for our research are Allianz Malaysia Berhad and also Prismetal Aluminium Holdings Berhad. These sectors is expected to produce a number of favorable justifications, consisting of increased investment in digitalization and automation, growing global demand, and continuous technical improvement. Researchers predict that environmental consciousness and sustainability will grow in importance as more customers and investors choose business that uphold these principles and produce eco-friendly goods. Next is about energy industry. There was an obvious rising trend in the energy industry during the period of January to July 2024. We had chosen Dayang Enterprise Holdings Berhad for our research. Over the coming decades, there will likely be a significant rise in the world's energy needs. This is mostly because of the anticipated increase in global population as well as the industrial and economic development of developing nations like China and India. The necessity for baseload, dependable electricity, and the threat posed by climate change are two strong reasons that will always justify the use of nuclear power. Our comprehensive energy policy would be incomplete without nuclear power, which supplies over 60% of our low-carbon energy and about 20% of the nation's electricity. There was a reasonable upward trend in the transportation and logistics sector from January to July 2024, and we had chosen post-Malaysia Berhad for our research. In a constantly changing landscape, the logistics industry is propelled by the technological advancement, process automation, and also environmental sustainability. To succeed in this highly competitive era, logistic companies must quickly embrace innovative technologies, advanced processes, and also strategic methodologies. Logistic companies handle numerous moving parts daily. To stay organized and manage their operations, real-time visibility into supply chain is crucial. Achieving this can be done by integrating EDI and also APIs. When it is properly integrated, EDI and APIs can enhance supply chain visibility and also facilitate onboarding. The next is about the financial services industry. The financial services industry showed an upward trend from January to July, and we had chosen DBS Holding Holdings for our research purpose. As concerns about inflation and also high interest rate continue into the new year, financial services trend advise keeping track of all development pertaining to the financial services industry, particularly in the banking and capital market sectors, in order to be ready for any significant changes that may arise in real time. Efficiency and automation are indications of new technology that should lead the way. By 2024, generative AI is predicted to be the most significant development affecting the financial services industry as a whole. This graph indicates that from January to July, the telecommunication industry showed a decreasing trend. Our group had chosen Singapore Telecommunication for our research. Taxes, inflation, and also interest rate all have an impact on the telecom sector. Expenses have an impact on the price for each plan that is provided to clients, which have affected customers who do not reside in urban areas. Moreover, legislative obstacles frequently affect the telecommunication sector. Products are constantly evolving, often replaced by newer versions considered better depending on perspective whether from customers or companies. This renders the previous iterations redundant, potentially leading to unemployment for those involved in their development. There was a sharp decreasing trend in the plantation industry starting from May 2024, while our group has chosen Sungai Bagan Rubber Company Berhad for our research. The slow pace of mechanization and growing reliance on foreign workers present an uphill battle for Malaysia's oil sector. The general productivity and expansion of the industry will continue to be hampered by this condition. The supply and demand of palm oil within the region, along with competing oils and the stock levels in exporting and importing countries, directly and immediately affect its price. As the most produced and traded edible oil worldwide, palm oil is constantly subject to price volatility due to unpredictable supply and demand situations in the edible oil and oilseed market. That's all from me. Thank you.
Founded in Germany in 1890, Allianz Malaysia Berhad is a member of the Allianz Group and operates with 32 branches across Malaysia. Listed on Bursa Malaysia Securities Berhad, Allianz Malaysia aims to be the most reliable financial services provider, meeting Malaysians' long-term needs while upholding corporate citizenship. The performance indicators for Allianz Malaysia from 2021 to 2023 show significant improvements. The net profit margin increased from 5.47% in 2021 to 17.10% in 2023, indicating growing revenue and profitability. Earnings per share (EPS) rose from RM1.98 in 2021 to RM2.97 in 2023, while the return on equity (ROE) went from 8.49% to 16.44%, reflecting efficient management and strong growth. The price-to-earnings ratio fluctuated, ending at 5.94 in 2023. The market-to-book ratio increased from 0.46 in 2021 to 0.61 in 2023, suggesting investors are valuing the company's assets more highly. The debt-to-equity ratio decreased from 4.71 in 2021 to 4.04 in 2023, indicating reduced financial risk. Technical analysis shows bullish pattern in the stock performance, with green candlestick indicating upward price movement. The MACD line has consistently risen above the signal line since January 2024, signaling a bullish trend. The RSI remains between 30% and 70%, suggesting neutral momentum. As a result, Allianz Malaysia Berhad has been chosen as one of the portfolio companies for the financial services sector in its initial formation. Dayang Enterprise Holding Berhad, founded in 1980 as DESB, launched on Bursa Malaysia's primary market in 2008. Initially trading hardware supplies and labor for the offshore oil and gas industry, Dayang expanded into maritime vessel chartering, fabrication, hooking up and commissioning and maintenance services. Performance indicators for Dayang from 2021 to 2023 show significant improvements. The net profit margin rose from negative 59.37% in 2021 to 24.42% in 2023, indicating a recovery from previous losses. Earnings per share (EPS) improved from negative 28 cents in 2021 to 19 cents in 2023, and return on equity (ROE) increased from negative 26.52% to 14.40%, highlighting a return to profitability. The price-to-earnings ratio fluctuated, rising from negative 2.77 in 2021 to 8.10 in 2022, then dropping to 8.35 in 2023. The market-to-book ratio increased from 0.59 in 2021 to 0.97 in 2023, suggesting the stock is still undervalued but improving. The debt-to-equity ratio decreased from 0.55 in 2021 to 0.33 in 2023, indicating reduced financial risk. Technical analysis reviews consistent share price growth from January to February, suggesting a good buying period. The MACD line has been rising above the signal line since December 2023, indicating a positive trend. The relative strength index RSI remains between 30% and 70%, showing neutral momentum. Consequently, Daya Enterprise Holdings Berhad was chosen as one of the portfolio stocks for the energy industry in the initial formation. Post Malaysia Berhad is Malaysia's primary postal service provider authorized to offer universal postal services. Based on Bursa Malaysia Securities Berhad, the company has shown varying performance from 2021 to 2023. The net profit margin remained negative through improving from negative 50.12% in 2021 to negative 8.40% in 2023. This trend, common in operation-intensive sector like transportation, is due to rising operational cost averaging income. Earnings per share (EPS) also stay negative but improved from negative 43 cents to negative 20 cents over the same period. Return on equity ROE increased from negative 40.88% to negative 25.59% in 2022 but dropped to negative 31.46% in 2023, indicating continuous losses for investors. The price to earnings ratio was negative throughout from negative 1.53 in 2021 to negative 2.45 in 2023, suggesting undervaluation or poor historical performance. The market to book ratio rose from 0.63 in 2021 to 0.78 in 2023, but remained below 1, hitting a potential issue. The debt to equity ratio increased from 2.31 in 2021 to 3.35 in 2023, indicating high financial risk due to heavy reliance on debt financing. Technical analysis shows bullish pattern, especially in February, suggesting a good buying opportunity. The MACD line has consistently risen above the signal line since January 2024, indicating a bullish trend. The relative strength index RSI stayed between 30% and 70% with a dip below 30% in January 2024, signaling an oversold state and generating buy signals. Thus, in the initial formation, Post Malaysia Berhad was chosen as one of the portfolio stocks for the transportation and logistics sector. That's all my presentation. Thank you.
Hi, my name is Xiu Zitian and metric number is 287266. Press Metal Aluminium Holding Berhad is a Malaysia-based aluminium company that is listed in Bursa Malaysia. The company main business is producing and selling aluminium product both downstream and midstream. The company net profit margin increased from 3.03% in 2021 to 17.55% in 2022, then fell to 8.07% in 2023. Earning per share rose from 12 cents in 2021 to 17 cents in 2022, then declined to 15 cents in 2023. ROE surged from 6.78% in 2021 to 34.38% in 2022 before dropping to 13.26% in 2023. The P/E ratio fell from 45.04 in 2021 to 27.86 in 2022 and rose to 32.41 in 2023, indicating investor expectation of higher earning growth. The market to book ratio decreased from 9.18 in 2021 to 4.69 in 2023 with a ratio above 1 potentially indicating overvaluation. The debt to equity ratio decreased from 1.89 in 2021 to 0.83 in 2023 with the higher 2021 ratio suggesting past reliance on debt financing. Press Metal Aluminium Holding Berhad was selected as one of the portfolio stock for industrial product and services sector due to several compelling indicators of its positive market performance. Candlestick analysis reveal consistent bullish pattern, especially in April, indicating upward price movement. This is supported by the MACD indicator, which show a continuously increasing MACD line above the signal line from February to April, signaling a strong bullish trend. Additionally, the RSI for Press Metal Aluminium Holding Berhad remained between 30% and 70% in 2024, indicating neutral momentum and a balance between bullish and bearish perspective. Notably, on February 7, the RSI dropped to 25%, entering an oversold or undervalued state, which generated a strong buy signal. Next is BS Group Holding Limited is a Singapore investment holding company that listed in Singapore Exchange. It has provided a variety of financial services. In 2021, the company net profit margin was 43.7% before dropping to 18.33% in 2022 and then rising to 54.77% in 2023. EPS increased from 9 ringgit 11 cent in 2021 to 13 ringgit 51 cent in 2023. Then the equity return on equity ROE varied, decreasing from 10.74% in 2021 to 5.30% in 2022, before increasing to 17.74% in 2023, showing strong management in 2023. The P/E ratio dropped from 9.99 in 2021 to 7.61 in 2023, indicating it may be currently seen as undervalued. The market-to-book ratio has increased from 1.16 in 2021 to 1.27 in 2022, but declined to 1.22 in 2023. The ratio of debt to equity increased from 10.89 in 2021 to 12.03 in 2022, then decreased back to 10.88 in 2023. In the figure above, bullish pattern are prevalent, especially from March to April, suggesting a buying opportunity. The MACD line blue has been rising above the signal line rate since February 2024, indicating a bullish trend. Key periods are mid-March to early April and late April to mid-May, where the MACD line consistently stay above the signal line. The RSI of the DBS Group Holding Limited in 2024 remained mostly between 30% to 70%, indicating neutral momentum and balance between bullish and bearish views. However, the RSI dropped below 30% from January 19 to 23, signaling an oversold condition and generating a buy signal. Therefore, DBS Group Holding Limited was chosen as a portfolio company for our financial sector. Sungai Bakar Rubber Company Malaya Berhad is a Malaysia-based company which is engaged in the production and sale of fresh oil palm fruit bunches. The company net profit margin dropped from 282.44% in 2021 to negative 21.66% in 2022, then increased back to 118% 0.86% in 2023. This change showed that even though the revenue is going up, higher operational costs can also have a negative effect on profitability. In 2021, EPS decreased to negative 17% in 2022 before increasing to 24 cents in 2023. The ROE change dropping from 8.64% in 2021 to negative 1.26% in 2022, then increasing back to 5.89% in 2023. Financial troubles are suggested by the negative ROE in 2022. The P/E ratio dropped from 4.73% in 2021 to 19.61 in 2022 before rising to 13.4 in 2023. The market-to-book ratio increased from 0.34 in 2021 to 0.36 in 2022, then decreased to 0.33 in 2023. The picture displayed above, particularly for the month of May, displayed a bullish signal, suggesting it could be a good idea to make a purchase. The blue MACD line has been consistently increased over the red signal line, especially in May, indicating a favorable trend. The RSI evaluate of momentum of price. By 2024, the company's RSI is at a level of 30% to 70%. Therefore, Sungai Bagan Rubber Company, Malaya Berhad, a company in the plantation sector, was selected to be included in the original portfolio reconfiguration.
Hi, my name is Tomai, metric number 284954. Singapore Telecommunication Limited is a Singaporean telecommunication company and it serves as the country's primary fixed line provider as well as one of four main mobile network carriers. From the fundamental analysis, we saw that the net profit margins rose from 2021 and 2022 and sharply declined in 2023. Earnings per share increased from 2021 to 2023. The ROE increased in 2021 and 2022, then decreased to 1.17% in 2023. A company management is more successful in 2022 at producing revenue and growth from its equity funding due to the greater ROE in 2022 compared to 2023. Other than that, the P/E ratio dropped significantly from 64.7 in 2021 to 18.32 in 2023. P/E ratio of 18 indicates that the market value of the business is currently 18 times its yearly earnings. Market-to-book ratio rises from 1.35 in 2021 to 1.57 in 2023. Increased ratio may indicate the company is overpriced despite its strong performance. Over 3 years, from 2021 to 2023, the company's P/E ratio has not been steady. After declining from 0.81 in 2021 to 0.75 in 2022, the ratio climbed to 0.79 in 2023. We chose this stock due to some reasons. The candlestick shows bullish patterns, especially for June, suggesting that the purchasing would be a wise course of action. In addition, we saw the MACD line has evidently and continuously increased above the signal line in June. As a result, it displayed a rising trend and a bullish signal. Besides that, we used RSI to evaluate this stock. The stock of Singapore Telecommunications Limited is in a neutral momentum zone, which shows that the company's relative strength index is nearly between 30% and 70% in 2024. It also symbolizes a middle ground or compromise between bearish and bullish perspective. For this reason, we choose Singtel as one of the portfolio stocks in second balance. An investment of 500,000 ringgit will be allocated to a portfolio consisting of 5 stocks, namely Alliance Malaysia Berhad, Dayang Enterprise Holding Berhad, Post Malaysia Berhad, Pressmetal Aluminium Berhad, and DPS Group Holding Berhad. The portfolio began its investment on 2nd January 2024 with a 20% weight given to each stock. The portfolio remained passive from 2nd January 2024 to 3rd May 2024, which means it's just only invested share in this portfolio. We saw that all stocks have positive return except Post Malaysia with negative 0.00831. The portfolio return is 0.172 and the standard deviation is 0.0076, means it is a low risk portfolio and the Sharpe ratio is 6.1782. On May 4, 2024, our portfolio went through the first rebalancing process. We included Sungai Bagan Rubber Company Malaysia Berhad in our portfolio. This is because adding a company from the plantation sector will improve the diversity of the portfolio and be essential for strong investment performance. From the figure of efficiency frontier, we saw that portfolio A had the lowest standard deviation 0.6022% with the efficient portfolio return 55.27%. The portfolio B shows the highest return and standard deviation, means it needs a higher risk to gain a higher return, while the portfolio C return is lower than A but standard deviation is higher than A. Therefore, portfolio A is the most efficient portfolio and it is the optimal portfolio. We use solver function from Excel to find the weightage for the optimal portfolio. It helps to find the highest return and lower risk. After using solver to find the optimal weightage, we saw that the return of Alliance Malaysia Berhad, Dayang Enterprise Holding Berhad, and Pressmetal Aluminium Holdings Berhad had slightly dropped, and the DBS Group Holding Limited had dropped to a negative value. However, the return of the Post Malaysia Berhad had increased from a negative value to a positive value. Sungai Bagan Rubber Corporation Malaysia Berhad, which is an additional stock in the first rebalance period, had a return of 33.35%. After the first rebalance period, we had already succeeded in decreasing the Sharpe ratio from 6.1782 to 5.6797. On May 4, 2024, our portfolio went through the first rebalancing process. We included Sungai Bagan Rubber Company Malaysia Berhad in our portfolio. This is because adding a company from the plantation sector will improve the diversity of the portfolio and be essential for strong investment performance. From the figure of efficiency frontier, we saw that portfolio A had the lowest standard deviation 0.6022% with the efficient portfolio return 55.27%. The portfolio B shows the highest return and standard deviation, means it needs next despite the entire portfolio return and risk having lower after the initial rebalancing, we expect to achieve more favorable outcome with regards to our objective. As a consequence, on the 1st of June 2024, we completed the second rebalancing, adding one new share to the portfolio, which is Singapore Telecommunication Limited. We made the decision to invest in the information and technology sector because as a result of our research, we anticipate that its market share will increase in the future. From the figure of efficiency frontier, we saw that the optimal weighted portfolio A, which brings a portfolio return of 33.91%, has the lowest amount of standard deviation, near to 0.5922%. Portfolio B has the greatest return of 35.46%, but it also has the second highest standard deviation of 0.5926%, which indicates that portfolio has a high level of risk. The portfolio C has the lowest return of 33.96%, but the highest standard deviation of 0.5929%. It means that portfolio C is risky but also unable to get a favorable return if invested in this portfolio. As a result, according to the outcome of the efficiency frontier, we will definitely choose portfolio A because we want to minimize the risk and optimize the return. After using solver function from Excel, we saw the weightage of each stock are different compared to first rebalancing. In the second rebalancing, there are some of the stock have negative return, which are Alliance Malaysia Berhad, Post Malaysia Berhad, TPS Group Holdings Limited, and Sungai Bagan Rubber Corporation Malaysia Berhad. From this stock, the additional international stock Singapore Telecommunication Limited generate the higher return of 0.0612. The total portfolio return of all stock is 1.2234%, while the portfolio standard deviation is 0.5772%. As a result, the total portfolio return decreased from the first rebalancing, which was from 5.9203% to 1.2234%, while the portfolio standard deviation also decreased from 0.9898% to 0.5772%, while the Sharpe ratio has also decreased from 5.6797 to 1.6025. Next, despite the entire portfolio return and risk having lower after the initial rebalancing, we expect to achieve more favorable outcome with regards to our objective. As a consequence, on the 1st of June 2024, we completed the second rebalancing, adding one new share to the portfolio, which is Singapore Telecommunication Limited. We made the decision to invest in the information and technology sector because as a result of our research, we anticipate that its market share will increase in the future. From the figure of efficiency frontier, we saw that the optimal weighted portfolio A, which bring a portfolio return of 33.91% as the lowest amount of standard deviation, near to 0.5922%. Portfolio B has the greatest return of 35.46%, but it also has the second highest standard deviation of 0.5926%, which indicates that portfolio has a high level of risk. The portfolio C has the lowest return of 33.96%, but the highest standard deviation of 0.5929%. It means that portfolio C is risky, but also
Based on the table, the beta value of 7 stock was below 1 in both the first and second rebalance. This suggests a stock is not more fluctuating than the overall market, resulting in a lower risk entry to a portfolio. Besides that, Sungai Bagan Rubber Company recorded a negative beta of negative 0.40 in the first rebalance and negative 0.31 in the second rebalance, while the CAPM is the highest in both rebalance with a value of 0.4138% in the first rebalance and 0.3897% in the second rebalance. This shows that the company is low risk but has a high return. A negative beta may safeguard investors from market downturn while lowering the portfolio risk. It also can enhance the total risk of the portfolio along with risk-adjusted return. In addition, Singapore Telecommunication Limited also recorded a negative beta with a value of negative 0.01, along with the second highest CAPM, which is 0.3020% in the second rebalance. Thus, we choose to allocate to equity the greatest weightage, which is 24.11% in the second rebalance. According to the result of CAPM, there are no adjustments following the second rebalance portfolio since all of the stock recorded positive CAPM values. In the initial portfolio, all of the stock have a positive portfolio return, while only Post Malaysia Berhad has a negative portfolio return with a value of negative 4.15%. As a result, the stock of Sungai Bagan Rubber Company was added to this portfolio. Having expanded stock in a portfolio might lower the overall risk while reducing the consequences of underperformance on the whole portfolio. Following that, the international stock which is Singapore Telecommunication Limited was also added to this portfolio with a greater weightage since it has a low value of beta but a high expected return among the stock. International stock provide diversification for Malaysian investors, lowering dependence on local market while possibly increasing profit. It may offer exposure to the global economic expansion, elevate geopolitical concern along, allow investors to get access to business that are underrepresented locally. To sum up, our initial portfolio made a profit with a value of 86,009 ringgit and 2 cents and a total portfolio value of 586,009 ringgit and 2 cents. After the first rebalancing, our portfolio still achieved a positive return with a value of 34,693 ringgit and 43 cents. However, the return is lower than the previous, and the total value of the current portfolio is 620,702 ringgit and 45 cents. After the second rebalancing, the return was lower than before, with a value of 7,593 ringgit and 46 cents, and the total value of our portfolio rose slightly to 628,295 ringgit and 91 cents. In addition, the total profit of our portfolio was 25.6592%, which is higher than the KLCI of 8.632%. Besides, when we compare the risk which is the standard deviation between our portfolio and KLCI, the overall risk of our portfolio is lower than the KLCI. In conclusion, according to the return result of our portfolio, this portfolio is worth continuing to be invested in. That's all for our group. Thank you.